beautiful people. Y'all, we about to get into it. The stock market pay my bills. Okay, the stock market pays my bills. To be exact, the strategy cover calls pay my bills. So those who don't know me, hi, my name is Paris Smith, and I was able to retire myself from the 9 to 5 at 24 years old. I actually was able to produce an six-figure trading account. This is an annual income. My first 6 months trading. So, hey, Jess, which is amazing. Coming from a beginner who knew absolutely nothing about trading, absolutely nothing about the stock market, who had a learning disability and learned how to trade this strategy that pay my bills and retired your girl. Listen, if you want to learn more about this strategy, I am having a free stock trading masterclass coming up. So click the link in the description to register. Make sure you do that to secure your seats, okay? To secure your seats. But the strategy doesn't require any charts, so we're not day trading or anything. We trade once a week. It takes less than 3 minutes, and I always say, in my case, 30 seconds. We click the same buttons every single week. And we either trade Mondays, may trade on Friday. It's a really simple strategy, and you make your profits the same day. It is a low risk strategy, and you also can rely on the income. Thank you. I appreciate that. You're so sweet. So let's go ahead and get into it. I wanted to talk about the pros and cons. So all the good things that come from trading this strategy and all the things that's like, you might want to consider. Okay. One thing about your girl, you're going to know it all. Okay. You're going to know the good, the bad, the ugly, the cute. You're going to know it all. So allow this to make your decision and see if trading this strategy is for you or not. Now, I got my notes over here because I want to make sure I don't miss nothing. Okay. All right. So we're going to start with the pros. Let's start with the pros. And so the first one is income generation. Okay. Income generation. And I told y'all this strategy pays my bills. You can literally come up with a strategy, trading this trading strategy, where it'll pay your bills or it can pay your debts. I started off with that. I started trading the strategy. My first goal was to pay the debts. I was like, okay, I'm working my 9 to 5. And I said, I have this income coming in. I think I was probably making the same at that time. Might have been a little bit more when I was like, all right, we're going to kill this debt. We're going to kill this debt first. And so that's what I did. And then eventually my trading income doubled from what I was making at my 9 to 5. And then I was like reconsidering, do I stay at this funky job or do I go? Anyway, let's continue. So income generation. So you receive a premium upfront for selling the call, which I love. I love that so much. Providing immediate income and potentially boosting overall returns. So here's how it works. When you're trading, right? When you're trading a cover call, when you click on the button submit, you make your money right then and there. Hi guys. You make your money right then and there. So as soon as you click on submit, you made your profit from the trade immediately. It's fire. So you make your income up front and it provides you immediate income. And so I think I told this story the last time I was live. When I made my first trade, the first company that I trade was AMD at the time. I don't trade AMD now. And I made $250 my first trade, and I couldn't believe it. And so at the time, my broker was TD Ameritrade, and they gave you a debit card. I took that debit card and I went to the gas station because I couldn't believe that I made the money. And when I went to the gas station, I swipe, and the gas was pumping in my car. I couldn't believe it. You really do. You make your income immediate. So when you submit your trade, you'll just look at in like the cash column, and you'll see your profit. Your profit there. Take a look at my nails. Okay, they still look good. Okay, so that's one pro. Okay, that's one pro. Now the second one, this is another one that I really, really like, you know. So the premium, so let's say we're in a down market, and y'all, I'm sorry I look rough. I just got off the plane. I look crazy. But anyway, so downside protection. So let's say we're in the market, right? And let's say the stock that we are invested in, because cover calls, you must own 100 shares in order for you to trade it. Let's say we end up in the market and that thing just going down. Now, when you're in a stock and you trade in a cover call, your money in it, and the stock starts to go down, let's say the market is a little pullback. That means it's going down a little bit. The premium that you've collected provides a cushion against small declines in the market, which is so cool. I will answer your question in a second. I'm gonna get through this. So the premium collected provides a cushion against small declines in the stock price, reducing the overall cost basis of the investment, which is so bomb to me. So let's say I'm in a stock, let's just use AMD. I'm in AMD, the stock drops a little bit because of a, let's say, pullback season or whatever, like September, I don't know. Just because it pulled back, your account value is going to drop with it, right? But on the other hand, you collected premium that provides that little cushion. So it's like a break even. It almost like a break even. And then also it reduces your cost basis so you can jump in that mug at a lower price. Do y'all hear me or do you hear me? I ain't trying to act up too much. I'm in my sister's apartment. I ain't trying to act up too much. I'm not at home. But do you get me? My voice echoing. Okay. So that's two. Downside protection. So one, we said income generation. That is a pro. The second pro is downside protection, which is my favorite. Y'all cry if you want to because the market going down. I'm going to buy it up. Okay. Okay. Number three. We on number three. Number three, and if y'all can like this video, like it up, like it up, like it up, please. Number three is the simplicity. The simplicity. So this is another favorite as well. The strategy is so straightforward. When I say it is so easy and it makes me sick, because a lot of people say that the stock market is hard. Learning the stocks is hard and trading is hard. This strategy is so straightforward. So it doesn't require complex technical analysis or constant market monitoring. So I told y'all, thank you for the one person that liked. I appreciate you. I appreciate you. Yeah. So with this strategy, I always tell y'all, we don't need to trade with any charts. We don't need to do all these technical analysis and trying to see where the stock price is. We don't care about that. It's because this type of strategy, you are investing and you are trading at the same time. Okay, so the simplicity of it all is it's easy. Literally, let's say you're trading on Monday, right? Or whatever day you decide to trade, you pull out your phone or maybe you're on your computer. You go ahead and it's like a form that you fill out. You fill out the form, you press the button. That's it. So it doesn't matter if the stock price, went up a little bit. It don't matter if the stock price is the same from last week. It doesn't matter if it came down just a little bit. You're going to fill out the form and we're going to trade it. And we click, and when we submit, the monies is in our account in the cash column. Let's continue. Number four. Okay, number four. So another pro to the cover call strategy. Number four, low risk. It says lower risk, okay? Lower risk. So This strategy compared to other strategies, this strategy is lower on the risk side. So I know every time I talk to people in like the financial world, those who are like financial planners, they do retirement planning, death benefit stuff, like what they call those? What kind of insurance is that? Y'all know what I mean, like insurance. What is, I can forget the name of the insurance, but anyway, every time I mention to them that I trade cover calls, they're like, "Oh, that's the low risk strategy. That strategy is the low risk strategy." Everybody know this strategy, especially in the financial world, as the low risk. Yeah, life insurance. Thank you, y'all. The low risk, right? So I'm gonna read to you what it says. So, and here's what makes it on the low risk side, and I may have to add a little bit to this because this ain't enough. So, since you already own the underlying stock, pause. In order for you to even get into, in order for you to even trade a covered call, you must own 100 shares. Okay, so keep that in mind. So, since you own the underlying stock, you are protected from unlimited losses that would occur. So let me elaborate a little bit. So y'all know with day trade, yeah, with day trading, when you're purchasing like the option, I don't know if y'all have ever day traded before, but the numbers move like this. Like it's not a stable. As soon as you purchase the option, numbers go up and down. Like it's not a stable number. And one small movement in the stock price is like a gigantic movement, either good or bad, with the option contract, right? And so with cover calls, you have to own 100 shares of stock. That's one. Okay, we're gonna go over that too. Two, when you're trading an options contract, you're taking in the premium. So like I said up front, you're taking in the premium as income, right? Now, the second thing that comes to my mind when it comes to this strategy, and only if you do it right, because you can definitely trade risky with cover calls, but you have to know the fundamentals of the stock. You gotta make sure it's like a stock that has all the fundamentals. You know, revenue look good. The revenue, the annual revenue, the 5-year chart, like it has to look like it's uptrend, stuff like that. But I talk more about this in the free masterclass, so definitely come to that. I break that down a little bit more there. But anyways, just because the stock has the fundamentals, which is not a risky stock, you lower your risk right then and there. Now, when it comes to owning the actual shares, so if the stock was to drop, let's say for an example, because everybody think stocks is risky. Everybody think the stock is going to zero for some reason. I don't know why. But if it makes you comfortable, just because you own 100 shares of stock, just know that you can still trade it because you own the shares, right? So if it drops, okay, so let's say you own 100 shares, it's dropping, it's dropping, it's dropping. Yes, your account value is dropping, but you can still trade it and pay your bills. And just because it's dropping like that, it's something called volatility swell. The premium gets juicy. Now, if you know some strategies on trading in a down market, you know you all right. You know you winning right now for real. But anyways, let me continue. So number 4 is lower risk. Number 4 is lowered risk. Dope to me. I'm not a girl that trade risky. I cannot trade risky. I can't do it. Okay, so anyway, let's continue. Let's get the likes up to 40 if we can. Hey, let's get those likes up to 40. Okay, so number 5, we got 2 more, and then I'm gonna go to the cons, the things about cover calls. We're gonna talk about it, cause that's who I am. Okay, you're gonna know all the goods, the bad, and the ugly. Okay. All right, so let's do this. Number 5. This is also another favorite. I am obsessed when it comes to investing. Like I love trading. I do. I love trading. I love cover calls. I love when I trade, I make my money, I pay my bills, and I do whatever else I won't do it, right? Cool. But I feel like this year and in the season that I'm in, I love investing, which means you just sitting your money in a stock and you letting that thing ride. And you make the dividends, you make the equity when the stock goes up. Like, it's just so fun to me. And I'm just so obsessed. I don't know what to do. But anyways, number 5, the combined income and long-term growth. This is a con, another con of trading the cover call strategy. So you have the combined income, which we're trading it here, and then you have the long-term growth, right? It's, it being combined. So it allows you to benefit from dividend income, potential stock appreciation, and call premiums. Y'all need to stop playing. Y'all need to stop playing. It's too good. So not only are you a trader, like you're trading, but you're also an investor of the same stock that you're trading. And then you also make dividend payment, like make the dividend income. If you really strategically set this thing up, you good for life. Okay, you got the income that comes in that pays your bills. You can plan that out. You got the income that comes in from the dividends. You can plan that out. Then you got the sprinkle on top, which is the stock appreciation. Just means when that's a little more complicated. We ain't even about to get into that. Jesus, that's a little too much. Y'all would be confused. We're going to baby step it, okay? We're going to baby step it. But just if you want to search it, search potential stock appreciation. But those who are in my program, y'all should know what that means. Y'all should know what that means. Okay. I'm going to get to y'all comments in a second. And number 6, this is the last one. The last the last pro. This is the last pro of trading the covered call strategy. And then we'll get into the cons. Yeah, I'm going to baby step it for y'all. I'm going to baby step it. Okay, number 6 is the flexibility. And this is what I love too. You can choose expiration dates and strike prices based on your risk tolerance and the market outlook. So if you're like, if you know historically that September is a down month in the market, then you know how to trade it. If you know historically which month or when, whatever season the company is in, we can't be having no phone calls. I'm teaching right now. Can't be having no phone calls. All right, let's continue. You can literally, depending on the season of the company, because like y'all know, some companies have like up seasons, depending on what they sell. Some seasons they might be down a little bit because they're trying to wait for another holiday or something. I don't know, But you can basically choose the expiration date and the strike. Thank you. Please hit the like, okay, for your girl. I'm over here teaching my heart out so y'all can learn some things. And I'm on vacation. I'm not really on vacation. I'm just in Nashville. I flew into Nashville just now and popped up. My little phone don't even have the things I need. And I'm over here teaching y'all. But anyway, y'all see my commitment and my determination. Okay. Anyways, so it's the flexibility to choose your strike and your expiration based on what's going on in the market. Now, I'm in Tennessee. I'm in Nashville, Tennessee. Okay, so we went over the pros, okay? The pros of covered call strategy. We have income generation. We have the downside protection. We have the simplicity. We have lower risk. We have combined income and long-term gains, and then we have the flexibility. Now, let's look into the cons. So, number 1, limited upside potential. So, if the stock price rises significantly above the strike price, which you'll learn this more once you learn more about cover calls, But if the stock price rises significantly above the strike price, your gains are capped, and you may miss out on larger profits. Now, what I teach is one of the things about the limited upside potential. Yes, exactly. But what I do is I choose stocks that are like super boring. So that helps that. Yes, the long game. It's boring as heck, but it rises very slowly. And then number two, we have the stock assignment risk. And I noticed some of my traders, some of my students, Nicholas, join the free masterclass. The link is in the description. And at the end of the masterclass, I give everyone an opportunity to hop into the mentorship program, and that's where I teach all of my strategies. But number two is the stock assignment risk. So you have to figure out like what kind of trader you are with the cover call strategy. Like, are you that trader that don't care if you get your stocks sold, or are you a trader that's like, nah, I want to keep my shares? So number two is stock assignment risk. Just know that there are ways around this. Literally. If the option is exercise, which means somebody take your shares away from you, you may be forced to sell at the stock. Hold on. You may be forced to sell the stock at the strike price, potentially missing out on further appreciation. Hey, Cece. So that just means when we're trading a cover call, and let's say on Friday is when your shares are getting sold away, like the option contract is expiring, you either own the shares or you don't. So you have to figure out then in that moment on Friday your next step to making sure you keep your shares. And if you don't care about your shares, like me, half the time I don't care, then you just let it get expired. So you just got to figure out, what kind of trader you are. But there's ways around that. So that's con number two. Now, con number three, potential for losses if the stock declines. It says the premium offers limited protection, but a significant drop in the stock price can lead to sustainable losses. Now, I told y'all, when I was trading, it was February 2020. That was my first trade. Then March 2020, y'all already know what happened. It was COVID, and the market started falling down like crazy. And guess what? Although my account value was going down, baby, but it was the most I've ever made because of the premium. So yes, when a stock drops significantly, yes, you will see sustainable losses. Especially, don't have to be a stock that don't have the fundamentals. If I told your tail to make sure a stock had the fundamentals, you'll be all right. But I got a lot of people, a lot of people want to be grown and trade risky, but I teach my strategies on trading low risk as possible. Now, what you do is your business after that, okay? After that, that's you. But just know that if you choose a risky stock and if that thing drop, you can kiss it goodbye or cross your fingers and cross your toes that it come back up. But if you choose a stock that has the fundamentals and is less risky, then you might be all right. It'll come back up. You just got to have patience. Awesome. Okay, so let's go from the top. The cons of a cover call strategy. Number one, we have limited upside potential. We have stock assignment risk. Tesla is too risky. Number three, we have potential for losses if the stock declines. And number four, we have requires owning the underlying stock. So number four is requires owning the underlying stock. So y'all know in order to trade a covered call, you must own 100 shares of stock. Okay. So you need to have enough capital to buy, or you already own, the 100 shares of stock for each contract. Now, the reason why a lot of people love day trading is because they can flip their little funky $250 and thinking they're about to be a millionaire overnight. But cover calls, you have to come in with a little more money. I'll say about 1,500 on a low end. Don't expect to be making a whole lot. But if you want to, find a really good stock, maybe like 2,025. What's that stock my students trading right now? There's a stock that my students are trading right now. I feel like everybody trading that stock. I think it's at $22. Okay, HPE. Okay, look at my students in here. HPE, that's it. Is that $22 now? Because it was last week during our coaching call. Okay, so that is one of the cons. People don't like the fact that they have to buy 100 shares of the stock at a time to trade one contract. But if you knew how powerful this strategy is, you would do what you need to do. Do what you gotta do. What strategy do you know where you can invest in the stock and make an income and get the dividend income? But you don't want to save your monies up and take your time, if you don't have it like that, to purchase your 100 shares so you can start trading and making an income that's reliable, consistent, and guaranteed, and investing at the same time and getting the dividend income too. A lot of people don't want to start little. They don't like little beginnings. The small beginnings. People don't like small beginnings. Mm-hmm. Mm-hmm. So y'all just say, cover call's not for me. Then y'all go ahead and try to day trade. And guess what? Blow your money when you could have put that into cover call. Okay, let me keep going. So that's number 4. Number 5. Number 5 is opportunity cost. While your stock is tied up in a cover call, you may miss better opportunities elsewhere in the market. So these are the people that put their nickels and dimes together so they can go ahead and get 100 shares of stock to do that cover call, and that's all the money they got. And it's like, oh, on this side is another stock over here that's doing real good too. But y'all already know, my students, listen, my students know how I go, okay? We're not trading all these different companies. We ain't got time for that. We stick to that one because we know that one is going to pay us what it's going to pay us every single week. We ain't got time to be jumping in and out all these companies. Okay, that was number 5, opportunity cost. Now, number 6. Number 6 is market timing, dependency. The strategy can underperform in volatile or rapidly rising markets if the call is exercised before you realize your desired gains. I mean, I don't got time. I don't really care about that. Number 6 don't matter to me. Because I don't, so this is what it's saying. The strategy can underperform in volatile or rapidly rising markets, right? If the call is exercised before you realize your desired gains. So basically what it's saying is, if you chose a stock that is volatile or you chose a stock that is rapidly rising fast, maybe the strategy is not for you. Because when it comes to cover calls, you have to choose a stock that is boring. And that's where a lot of people fail. Because they like that fast stock that moves and all of that. They like the excitement. But if you find you a boring stock, you be all right. All right, so who is this strategy best suited for? Who is the strategy best suited for? Who is the strategy? Who is the strategy best suited for? Which means the cover call strategy. Okay, investors looking for moderate, consistent income. If you are looking for moderate and consistent income, this strategy is for you. If you are looking for long-term, if you are a long-term stockholder, which you are an investor, right? That's all I mean. Long-term stockholder who don't expect large price surges. Like I just talked about, a lot of people like the Teslas and all that stuff because it moves so fast. But if you're like me, who loves these slow and steady rises, then this is for you. So if you, so let's start from the top. If you are an investor who's looking for moderate, consistent income, this is for you. If you're a long-term investor who don't expect large price surges, this is for you. And you can still get those large price surges, but you're just like holding stock. Should be a whole different portfolio that's not connected to your cover call portfolio. So you can still like get in it, you know. 3, those who prefer lower risk trading strategies compared to speculative options trading strategies. So yeah, so if you're the type of person that prefers the lower risk trading strategies compared to the other options strategy like day trading, all that stuff, then this is for you. Now, this is not ideal for you if you are looking for large capital gains, because this is not that. This is that when you're taking your time, over a course of months, you're buying more shares, you're trading more contracts, you're saving, buying more shares, trading more contracts. This ain't no overnight success, no millionaire when you wake up. Like, this is not that. So if you're not looking for that and you looking for the large capital gains, then cover call's not for you. Okay. It's not ideal for traders who expect significant upward movements in stock prices. Because like I said, we choose boring stocks, so that ain't for you. And those who do not want to risk having their stocks called away. So we talked about that a little bit. If you don't want to have your shares called away, the risk of it, and I say it's like a 50-50 chance, you just don't know, then it's not for you. Now, of course, there's ways around it. But if you're in the mentorship, then you know the ways around it. And that's that, and that's all. All right, let me go look at the chat. Let me look at the chat. Let me get this hand. Because I'm about to go chill it. I'm tired, y'all. I've been up all morning. And I don't like flying in the airplane because I'm a lot of anxiousness and anxiety, and my brain been going for a minute. Okay, let me see. How long did it take to build your shares? I'm trying to stay motivated. So it took me 5 years because I ain't know nothing. So you be all right. But before it actually took me to like buy my first contract, when I was like, all right, game plan, probably took me 2 months. That was because I picked up a third job and I had just bought a house. So I was like, yeah, I don't want to put my savings in there. I was like, yeah, I need my emergency savings. So I picked up a third job and I put my check into my trading account. But I did what I had to do, and look at your girl now. So do what you got to do. It's okay. You'll be okay. You'll get there. It's okay. All right. Should we care about the value of the stock? Absolutely. We can't just pick anything. That no one taught me for years. Wow. Going to follow your strategy. Yes, I love that. Good for you, JP. All right, let me read. Let me see. Let me see here. Let me see here. Let me see here. I think I answered that question already. Yep, Amanda, you can have your shares taken. Basically, you can have your shares taken. It don't mean nothing, but it just think about this. If your stock price, if the stock reaches the strike that you chose, then it gets taken. So it's just the way it goes. All right, let me see now. 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 All right. I invest in crypto to see if I can grow my account so I can start cover call. I need to start it with 50. That's a lot. That's a lot starting cover calls with. But what characteristics should I look for in a low risk stock? So it would be the main thing that I look for is like the 5 year. So you gotta look at the 5 year, make sure for the last 5 years that the revenue has been increasing. That's really important. And then I just make sure that the stock offers a dividend or something like that because it means other investors are investing. So it's a few things that you look at. You just want to make sure that it's like foundationally strong, like fundamentally strong. It can't be no weak company, no penny stock. Mm-mm. When you mean, hold on, when you mean taking, do you lose the 100 shares? Yes, you lose the 100 shares, but you can just buy it back. It's okay. Talk about when you see as a contract. Amanda, ask your question again, Amanda. But that's pretty much it, y'all. With the whole pros and cons, it's good to me. This strategy is too good to me. It is too good to me. But that's pretty much it with the pros and the cons. For sure, this strategy is like a secret for real. Like nobody knew about it. And every time I talk about it, people are like, what is that? So I'm waking y'all up right now. I'm waking y'all up. If you want to learn more about this strategy and how to trade it, and also have an opportunity to join my mentorship program, I need to see you at my next free stock trading masterclass. I'm having one on Wednesday this week. And if you, yeah, so I have one on Wednesday this week. Excuse me, I need to see you there, okay? I need to see you there. How to determine if the appropriate strike price and expiration date for the call option I sell? That's a good question. That's too much to explain on here. It's too much to explain. It's too much, and I'm not trying to confuse anybody. Just come to the masterclass. Come to the masterclass. Or yeah. But anyways, y'all, I hope this was good to you. I'm about to go head to my sister's place and relax for today. I'm in Nashville. Really, my sister, I just saw my sister last week. I just saw my sister last week for for Thanksgiving. And I'm here. It's Monday. Y'all already know that. I'm here and I'm staying until Saturday. And it's finals week. So my twin sister, she's in a dental school. She will be a doctor of dental surgery. And it's finals week. And one of her friends had called her and said that she has a baby and, plans didn't go as plans. So I had to come down, fly to Nashville so I can watch the little baby while she take her finals. And I was just thanking the Lord because the Lord gave me the opportunity to give back to my community, not just monetary, not money stuff, but time. I have time freedom. If my sister classmates say, I need someone to come here and just help me with my 1-year-old while I take my finals so I can eventually be a doctor of dental surgery, you think I'm not about to step in and fly to Nashville so I can take the baby so she can go and take her test? That's what I'm gonna do. So I'm gonna be a mommy this week. I'm gonna be a mommy this week for a couple days, not every day this week. And I'm looking forward to it. I can't wait. And I get to hang with my sister. So it's a win-win. Love it, love it, love it. And since the Lord has blessed me so much with everything, I am so eager to be a blessing to others. So I'm here. I made it. I made it. I can really be a blessing to people, and I'm so excited. Anyways, y'all, with that being said, as long as you have a financial education, you will never, ever, 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 ever live in lack again. If you need me, you know where to find me. With that being said, your girl got to go. Goodbye.